Hello, everyone. Welcome to this month's live market update. Thank you, as always, for joining. For those of you who are new to this segment, I enjoy hosting these live updates once a month to unpack the things that we're seeing on the ground in the housing market in the Greater Toronto area. Of course, I always unpack some of the latest statistics from last month, also talk about the on the ground trends that are impacting buyers and sellers, things that kind of don't always flow through into the data or into the headlines. And as always, so we chat with the Gus and Davin from our office. And as always, we have David Larock, mortgage broker, who's going to help us unpack some of the latest trends impacting the mortgage market. And there we've seen a lot of change and volatility over the past little while. So we're going to jump in directly by kind of touching on that over the past several months. If we think about what has been the narrative, I mean, everyone, of course, has been talking about lower rates and a weak economy. And in the past month, we have somehow gone from this period of uncertainty to economic growth. And this is just a clip of David Larock's latest post where he talks about how our surprise jobs report is impacting mortgage rates. So we had strong job numbers, we had strong GDP, and this caused 5-year Canada bond yields to surge over the past week. And 5-year bond yields are what 5-year fixed mortgage rates are based off of. So we're starting to see rates actually tick up. And this headline from the Globe and Mail talks about how we shouldn't be surprised if the Bank of Canada raises interest rates next rather than cuts it. So I'm not going to go into this. We have David Larock joining us, but I just wanted to kind of plant the seed that this is one of the things we're going to chat about later on in today's segment. And again, I think it just speaks to the fact that the market is so unpredictable. We don't know where things are going. For the longest time, we're talking about future rate cuts. Now we're talking about rate hikes and economic growth and the market and the economy doing better than expected. So we're going to unpack that a little bit later on in the show and think about how that might impact housing. But for now, when we think about what the year ahead might look like, this headline, I think, caught everyone by surprise. This is from the Toronto Star with Royal LePage, a big brokerage, obviously predicting that GTA home prices will drop 4.5% by the end of 2026. Again, this is a bit surprising because these big national franchises don't typically predict price declines. I mean, they haven't been doing that. I don't even recall the last time they've done that, or if they have. They typically are neutral or optimistic, but here they're forecasting a decline in prices. So will things get worse before they get better? And again, I think that's one thing we'd like to try to unpack today, especially in light of these what seem like bullish economic indicators, but it may not necessarily mean strong, robust house prices and changes in the housing market. So I think there are a lot of things going on. We'll try to unpack some of those today. Now, taking a quick look at the latest housing price statistics in the Greater Toronto Area. Detached home sales were down 14% year over year. We're slightly above the volumes we saw in 22 and 23. Those are quite low. But last year we saw, and I talked about this in the past, we saw this rally at the end of 2024. People thought 2025 was going to be a booming year, and they rushed into the market. But of course, the market actually ended up slowing down. It did not respond the way people were expecting, which was a hot housing market in the spring. Things actually got cooler and prices actually fell. So the sentiment shifted. So we're actually down year over year in terms of sales volumes. New listings are up a couple percent, but active listings, the number of homes available for sale in the month of November is up 22% year over year, and pretty much the highest volume for the month of November since the global financial crisis. So very, very robust supply of homes with very low transaction volumes. And when we think about the months of inventory, so this is just the number of homes available for sale, divided by the number of homes that sold to figure out how long it would take the current inventory to clear. We're about 4.5 months, which again is very elevated. I mean, we're in a range that is the highest, it's been since, it hasn't been any lower than this since 2015. I don't have I don't have a chart going further back beyond 2015, but we're among the highest range over the past few months. Even if we look back to 2017 and 2018, after the bubble kind of collapsed, that 2016, 2017 bubble, months of inventory is in the 3.5 range. Today we're in the 4.5 range. A little bit more distress, and it's leading to falling prices. When we look at the average price of low-rise homes, they are actually down 9% year over year, which is a relatively big number. People are seeing this on the ground, and I think it's an interesting dynamic. Again, for the longest time, prices, most of the decline happened in 2022. Prices accelerated dip, but for the most part, were pretty flat for a while. But we're starting to see this gradual decline in average prices in the GTA now. So when we look at the condo stats quickly, sales there are down 21%, similar to houses or detached homes. New listings for condos are actually trending down. Active listings are unchanged over last year. And similarly, months of inventory is relatively elevated, 6.6 months. Average prices for condos are down 4%, which is interesting. And one of the interesting things I want to talk about, because it is lower than houses. And, if we look at, so now we're going to kind of unpack what I think are interesting trends in the data. This one in particular kind of caught a lot of people off guard when they looked at the November statistics. If we look at sort of this table from the Toronto Real Estate Board's Market Watch report, it showed detached home prices in the GTA were down 8%, while downtown Toronto condos were down only 1.7%, which is a statistic that surprised a lot of people. They weren't expecting, condos to effectively outperform detached homes. But one of the factors behind this, I kind of dug into the data to try to make sense of what's going on. And this is where average prices can sometimes be misleading. One of the factors that's making the growth in condo prices, or I should say the decline, look a little bit better is that this year's prices were slightly skewed because more higher end homes sold. So for example, just imagine this November and last November, only 100 condos sold in the given month. If we look at the top 5% of those sales, so the top 5 units, what happened in 2025 is that those top 5% were far more expensive than last year's top 5 units. And imagine last year's top 5 units had an average price of 2 million. Maybe this year's top 5 had an average price of 3 or 3.5 or 4. And what ends up happening is that even though those are a small number of transactions, they end up pulling the total average higher. And this is one of the reasons why average prices in November 2025 look better than they probably otherwise would have if you accounted for this difference. So that's one of the factors, but it doesn't change the fact that certainly detached home prices are down a little bit more, surprisingly. Even if I account for that difference for the condo market, detached are still declining a little bit more than condominium prices, which I think is a little bit surprising. Not a lot of people predicted that. When we look at annual sales volumes, we're going to be at the lowest level, just over 60,000 transactions in 2025, assuming December's data is very similar to last December. And it's the lowest volume since 2000. So, the past 2 years were pretty much the lowest volumes in 25-year lows. And we're going to be less than 2023 and 2024 sales volumes. And again, a lot of this has been triggered by sentiment and economic uncertainty and just people moving to the sidelines, not wanting to jump in. Now, one question I get is, why the heck are people buying now? Given the uncertainty, given the soft prices, given that prices might be a little bit lower. And this, of course, is a tricky question because not everyone has the same motivations. A lot of people buying now want a home, need to move on. But some people are seeing a little bit of value. They're seeing that they could suddenly afford a home that wasn't possible even a year ago, or 2 years ago, or 4 years ago. And this is shaping their behavior and buying patterns. And so they're not necessarily rushing to time the market. They're thinking, I can get something now that wasn't possible even a little while ago. So I'm going to jump in. And the way I want to unpack sort of this idea, I mean, this again is a conversation fueled from a conversation with a client. I thought I'd look into the data, and I thought the statistics were kind of interesting. So if we look at low-rise houses that have sold for under 900,000. So by low-rise, I mean detached semi-townhomes, under 900,000. So, from the eights to the 700,000 price range for the most part. It kind of gives us a very good idea of this starter price point. And when we look at the number of homes sold, I'm going to first focus on the city of Toronto because I thought the statistics were a little bit more interesting. Then I'll show some numbers for the greater Toronto area. But when we look at the number of homes that had sold for under 900,000 in the city of Toronto, city of Toronto is a little bit more expensive than the suburbs. We can see that the volumes today are much higher than they were over the past 3 years, nearly double, and also a little bit higher than the number of homes that sold in 2021. So this year, just over, and of course, I'm counting this year, not ignoring the fact that the entire year isn't done yet. So we're missing 20 days worth of data. But if we look at 2025, just year to date, we've had about 1,600 homes sell in the GTA for under 900. Over the previous few years, it ranged from 800 to 1,000, so we're well above that. And when we look back to 2021, 2021 had just under 1,600. So they're seeing more options. But even when we compare it to 2021, that kind of statistic is misleading because home sales in 2021 were substantially higher than they are today. I believe in the city of Toronto, there may have been around 17,000 sales in 2021, compared to around 10,000 low-rise home sales in Toronto for 2025. So when we look at sort of these transactions as a percentage of all homes that are selling, we see a very different story. In 2021, just about 8% or just over maybe about 9% of all the homes that sold were sold under 900,000. Today it's closer to 16%. And the percentages range from, anywhere from 7 to 9% over the past few years. So as a stock of the total homes, we're seeing more homes selling for under 900,000. Again, this is making some people feel like suddenly I can afford a home in the city of Toronto. And when we look at the suburban statistics, we see a very similar trend. Looking at the share of homes selling for under 900 in the GTA, which includes the suburbs and the city of Toronto, we see a very similar trend where this has been increasing since 2022, and is also higher when compared to 2021. Now, the change from 2021 to 2025 is not as big. If we looked at the city of Toronto, nearly twice as many homes were selling for under 900 relative to the sort of the total stock, compared to, in 2021, about 20% of homes in the total 905 and the city of Toronto sold for under 900. Whereas today it's about 25%, so a modest change since 2021. And I think that's partly because in the city of Toronto, the homes selling for under 900 are for the most part fixer-uppers, or there's at least more fixer-uppers compared to the suburbs, where more of them are in moving conditions. So again, what we're seeing right now, the people who are jumping in are suddenly seeing that there are more options. They can afford homes they couldn't afford otherwise. And many of the buyers that we speak with, some of them acknowledge that maybe prices will dip further, but again, don't want to time the market and eventually just want to buy a home. So this is some of the motivation behind some of the buyers that are jumping into the market right now. And we're going to chat a little bit with David to think about what impact, if any, will this potential shift in interest rates impact buyer sentiment as we move forward. But before we bring on David, I'm going to bring on Gus and Davin from Realosophy to kind of chat a little bit about some of the trends that they're seeing on the ground. Gents, how are you?
Good. How you doing? Very good. Thank you.
Very good, guys. Thanks as always for joining. Gus, you're in the office. Maybe we'll kick it over to you. Some of the things that you've been seeing with some of your clients on the ground.
Yeah, a lot of the stuff you're saying, there's a lot more. It just feels when people contact me, especially a lot of first-time home buyers, somebody looking to get into the market, they feel it's a lot more affordable. So they're intrigued, they're interested, they want to start looking, they want to start planning. Even a few buyers who want to upsize, maybe get out of their condo or smaller home and upsize to a bigger home because again, they understand they'll get less when they sell, but they also understand they're going to purchase that bigger home for a lot less than they would have a few years ago. Just talking to agents also, like it, man, there's some desperation out there. You can negotiate, you can push, you can. Buyers need to understand that right now. Anybody that's thinking of buying any time the first half of the 2026, negotiate, man. Negotiate. Don't be scared. I've run into buyers where they're like hesitant. Should we? Can we? Yeah, of course you can. Yeah, yeah, yes, you should.
Yeah,
So
100.
negotiate.
And I mean, you mentioned something I think is important. We talked about it on this segment before when you just said, when I speak with listing agents, there's a lot of flexibility. And I think this is, I think a gap, at least in our industry that, we talked about this before. People don't pick up the phone, but all of the
Mhm.
gold I feel is on the phone. You know what I mean?
Yes.
No one is going to tell you via text or via email how eager or desperate their client is to sell. But over the phone, people will open up. And even if they don't, you can hear it in their tone. So I agree, it is critical because not everyone, and I think this is a mistake, everyone thinks they can lowball everybody. Not everyone's motivated, right? A lot of times it's like finding the ones that are eager and jumping on those opportunities rather than just throwing out offers everywhere, which is a bit of a waste of time. You got to decide and figure out who's motivated.
Yeah, that's a good way to do it.
Yeah, the ones that have been listed since, February 2025, multiple price drops, things like that, they're getting anxious. And you can see that in the listing history. And then couple that with talking to the agent. If you can get the agent on your side, like Gus is saying, it's a great opportunity. Absolutely. So it's hard to find them on the surface, what those ones are, but if you dig a little bit, yeah, you can probably suss a few out.
Yeah,
Yeah.
absolutely.
And I think for sellers that are on the market a long time, like I had one in September, where you gotta you also need help on the other side, and what I mean by that is you'll get agents who won't want to offer or won't want to. Well, they're lazy. They don't want to get into the negotiation. They don't want to get into the gritty stuff, right? And you got to really sometimes pull that out of them by getting on the phone and talking to them and saying, "Look, my client's reasonable. Give me an offer. Let's work this out." And I mean, I was thinking about this the other day. Like, it's crazy to me how 3, 4, 5, 8 years ago, whatever. I mean, think of we could all. I know this is more agent stuff, and maybe, but for buyers or that are out there, or even sellers, we used to sit in our cars or in our office and get a deal done in 2, 3 hours. We get
Mhm.
multiple offers, or we'd be putting in an offer with competing with so many other people, and decisions would be made within 15 minutes.
Yeah.
Yeah.
And everybody would feel rushed and stressed and now now it's just, I mean, decisions get made in a week. I've been negotiating one with Peter from our office 9 days.
Yeah.
And we bought it conditional like a couple days ago, and it took us 9 days, but
Yeah.
we got it done. And there's a lot of agents, well, or maybe they're not telling their sellers this. I don't know, but they're not willing to do that work, and that's I find that odd, and I
They're
find
not. You know what? I think a lot of agents I feel like aren't used to it. They're not
yeah,
used to these
Yeah.
drawn out negotiations. I mean, we have a client who's like, again, similar situation. They're buying, a lot of the homes are overpriced. They want to offer something more realistic. It's way under market, and they're like, should we even bother? Should we wait till the new year? And I said, listen, throw it in. Like at the end of the day, sometimes even if I don't think the seller is ready to come to our price today, right? What happens is when you throw in your offer and it's signed, it makes people think. Okay. And over the holidays, they think about their expectations and should we move on and should we just reduce and we're not getting anything and 3 weeks have passed and there's no showings and they'll come a lot of times they come back to us, right? And again, but the key part is they're not just going to jump back to anyone who's viewed the property to see if they want to make an offer. If you've made an offer, you've expressed serious interest, right? So if they've adjusted their expectations after 3 weeks, they're going to come back and say, are you guys still interested? So some of the things that we're doing now are not even about getting a deal today. It's like planting seeds. You know what I mean? In the seller's mind to get them to potentially adjust their expectations. It doesn't mean they're going to come back. If they don't need to sell, they're not motivated, they're not going to come back. But a lot of the times, if they're overpriced, they're going to look at it and they're going to adjust their expectations and give us a call back. So and I think today's agents who just only know about bidding wars, and that's all they've known, aren't used to this slower, patient approach.
Not just the agents, the sellers.
You're right.
The sellers are starting to understand this, that, oh, you mean like, yes, Mr. Seller, you have to sign back 3 times. Well, you have to negotiate the crap out of this, they're 75 grand off my price. Forget it. I don't even want to entertain them. No, you can't be like that. Not today. No way. Just work on it.
Yeah. Yeah, absolutely.
I've heard an agent story that a seller made an offer to a buyer who had come through previously. So like you said, John, if you're making an offer, 2 months pass, the seller is allowed to make an offer to that buyer.
That's interesting. You're right. That's kind of what I'm talking about. You're right. They have all their info. They have the original offer. That's interesting. So did that happen to one of your clients or did you just hear about that?
No, it was another agent just telling a story that I'd heard. And it was successful. So
that's exactly the same.
This is something that happens often, but nonetheless, these are the kind of things that can happen in a much different market. Like this would not happen in 2021 and all that. No chance.
No way.
No, absolutely not.
There's a good opportunity right now for a lot of people. Anybody that's looking, that's thinking, especially these first-time home buyers and what you highlighted about the sub 1 million. There's a really good, like from now until I think with the way the weather is too and how cold it is so soon, it's right. I mean, don't less buyers want to go out when it's this cold and there's snow coming and yes, the holidays affected too, but the cold and the snow also affected. So I think if somebody's actively looking right now, actively look more because from now until I would even argue second or third week of January, if the weather continues this way, there's going to be more and more desperate people who are just like, okay, let's just go. Let's just get rid of it.
I went from, nearly twiddling my thumbs for the end of November to having like 4 active buyers and like another person listing. Because I think people are seeing that sort of opportunity start to kind of, percolate out.
100%.
And they're ready to kind of take some advantage, or, it really depends on what each individual person thinks that 2026 will be, a little busier. I anticipate it to be a little busier. I mean, it's hard to not be a little busier. But you want to kind of hit the ground running. December it's not a terrible time to buy. It's not usually a good time to list unless you're like the belle of the ball. But like August, like right after New Year's and before Christmas, those are decent times to buy if there's product for you to look at. That's the only problem.
Yeah, I mean, I think
very good out there right now.
Yeah, listen, I think. Go ahead, Gus.
No, I was just saying there's not a lot of good stuff right now. It depends. Well, I should say it depends. If you're looking at freeholds, and there's not a ton out there. A lot of fixer-uppers still, a lot of duplexes, triplexes, that kind of stuff. But if you're looking at condos, I'm seeing a lot. Like if you want a 1+1 or a 2-bedroom condo right now, even 3 bedrooms, I was looking at this morning for a client. There's a good amount of inventory, obviously, and like I said, negotiate. So it depends on what product you're looking at.
Yeah, I mean, and touching on what Davin said, I mean, we're coming off of a pretty much lowest sales volume in 20+ years. I mean, odds are we'll probably be a little bit higher, but again, I don't think 2026 is going to be a booming market. I think Sales might pick up a little bit, but it might be in an environment of still softer prices. The best case scenario is probably flat prices, if you want to call best case scenario. But and again, I think part of this is, people, who are jumping in, I think like being in the driver's seat. Is from what I find, like the buyers who we have like having the sort of the negotiating leverage.
I wonder, this is a question for Dave, maybe ask him. I wonder if rates do go up early next year, if that or the sense of rates going up, it pulls some buyers forward as opposed to pushing them back like it did last year.
I know. I think this is one thing that I don't know. I'm trying to think about how that impacts the market. Does the idea that rates might go up? You're right. Does it, if that becomes the sentiment at the beginning of 2026 that the next move is higher rates, does it, I don't think it's going to lead to a flurry of activity, but does it potentially bring some buyers off the sidelines? I don't know. I think
I was renewing my mortgage sometimes this summer. I'd be calling my mortgage broker and be like, "Hey, what's going on? Should I do it now? Or should I wait?"
Yeah. But I think the one thing that's going to be hard to predict, and we talked about this before, is that there's a ton of distress still. Like there are a ton of households that are struggling financially with their debt, with their properties. And I've talked about in the past, about this rapid increase in power of sales, but again, for every power of sale, there's probably another 3 or 4 people on the verge of power of sale. And this again are some of the factors that lead to what we're talking about, that there are still a lot of motivated sellers, because if you're on the verge of power of sale, I mean, you want to sell on your own terms generally. You don't want to default, right?
I got a power of sale story.
Go for it.
I was out showing condos. What's today? Thursday, Tuesday night, and the selling agent met us because he was vacant, and I don't know. That's, I guess, the way the owner, they didn't want to just set up a lockbox. They wanted the selling agent to show it to us. So they showed up and showed it to us, and nice fellow who's probably been doing it, not probably, has been doing it longer than I have. Anyways, we leave the unit. We're just talking just overall, and somehow he was mentioning a couple other units that he has on the market that might work for us, and that one of them was a power of sale. And then he elaborated that he does a couple of these a year for the bank, and I'm like, oh, that's great. So wait, the bank refers you power of sales? He's like, yeah. I'm like, that's good business. I mean, how did you, anyway, small talk. How did you do that? Yeah, I started 12 years ago. I sold one. They liked me. And now every year they give me a couple of power sales. The bank does. So he's like, every year I'll get 1, 2, maximum 3. I'm like, oh, that's fantastic. He goes, yeah, I got 13 to start 2026. I got to look at 13 condos for the banks to evaluate them, to put them on the market for 2026. 13. I'm like,
wow.
Yeah. He's like, so what? He's going to do like 20 for the whole year? That's crazy.
Yeah. Yeah. And again, I think that's a good indicator of sort of the shift in the market and the momentum now, and what's driving some of the listings and the distress in the low rise market. So interesting anecdote. Do we have questions? As always, gang, please post your questions in the chat. I didn't mention it earlier.
We have one that's more for
David Larock.
Well, no, I guess we can. Yeah, more for David Larock.
We have one question. Do we think about the Greenbelt will be maintained? Whether we're going to be seeing more sprawl in the suburbs. I mean, it's very hard to say. I mean, it's a very good question. Again, I think one of the challenges, we're not building low-rise homes. A lot of condos are micro units. So people have started talking about perhaps building more low-rise housing in the suburbs and sprawling. I mean, ironically, when we look at a lot of states and cities in the U.S. that they say are building tons of housing, I mean, like Texas, this is what they're building, quite frankly. A lot of low-rise homes in the suburbs. They're not building 300 square foot condos the way we are. So yeah, we might see that in the future. But again, I think the key thing is we're not, new housing's stalling. We're not going to see much new construction. From an economic point, we'll talk about it, David. This of course is going to be a drag on the economy. So, because we're not seeing any new construction sales. Most of the statistics are showing that Ontario is going to be obviously going to see a big decline in housing starts over the next 2-3 years.
Mhm.
So on that, gents, I'm going to jump on and unless you have any other final, actually, no, let me ask you one final question. As we move into the holiday season, we should get a little bit festive on Move Smartly and maybe ask each of you if you have a real estate Christmas wish that you would like to see, whether it is in the industry or in the market, or I mean, really anything. Your real estate Christmas wish for 2026.
David?
I'm thinking.
Yep. So I'll go. If it's a widget, I mean, we're doing a lot more social media than we used to. So maybe one of those, what do you call it? The gadgets that carries the
Gimbal?
phone and
You want a
levels.
gimbal? You're
Gimbal.
easy. That's an easy wish.
I don't have one.
You just buy one yourself. What are you talking about? I'll get you a
Small
stinking
wish. We got to start small.
Yeah. You know, it'd be really nice and just helpful for everybody. And I know we don't see it as much anymore, but if in the MLS we have a spot that would just indicate whether you're having a friggin' offer date or not.
Oh, I know. Yeah, it's
Yeah,
true.
and that's so easy.
That's good.
Just
Yeah.
that'd be so simple.
Absolutely.
You know, things like that. They finally sort of mandated square footage. Just they got to mandate more useful information. They really have to.
I'll add to that. I wish that I agree with you 1,000%, but I also wish, and I've seen a few of them just this morning on condos too, which is crazy. And not to get in the weeds here, but when an agent prices a property low, they have an offer date. The offer date comes and then it goes. So then they get offers or they don't. And if they don't, the listing stays up. You're supposed to change that price from that incredibly low price to exactly what you want. I wish they would somehow force agents to change the price instead of leaving it $399 or $999 for a $1.5 million house for months on end. Meanwhile, they had an offer date back in October.
Mhm.
So it just how many clients do we get that messages that
Unreal. I know.
Yeah,
there
a
you
lot.
go. That's a good one, Devin. Thanks.
We do have questions now. You know,
Do it.
yeah.
Go for it,
Grab
and
it.
I'll end with my wish at the end. What's the question?
All right. When is the next seller's market?
Oh, I don't think 2026. I mean, I think maybe 2027. Like maybe you might see some green shoots at the end of 2026. It's hard to say. But again, like this is all like so impossible to predict. Like there's so many things that are impacting like the economy, interest rates. It's so hard to predict. You know what I mean? But I think most people agree it's not going to be, certainly not the first half of 2026. You know, if the market starts to pick up again in the second half, maybe, but even that, I don't think will be a seller's market. I think the best case is a balanced market where prices are flat. So I don't think we're going to see a seller's market in 2026. That's my guess.
And let's be honest, it's a seller's market for certain things in certain areas, always.
Mhm.
Right? So it really depends on what you're hanging on to. But for by and large, no, not going to happen. And we'll do one question real fast. Is cash flow positive the clearing price for all these one-bedroom condos in CO1? So downtown.
Gosh, for cash flow to be positive to be the clearing price, they've got to drop another 25-30% or something. Because I mean, and to unpack that question, the question really is, I mean, you know, if you buy a condo right now with 20% down and rent it out, you're going to be negative cash flow, like $800 a month, because the rent doesn't cover your mortgage, your property taxes.
Two things. Rents have come down.
Yes.
And the maintenance fees, which we've talked about in the past, have gone up.
Yes.
That, and even though prices have come down, it's still.
And interest rates are relatively elevated. So assuming you're going with 20% down, obviously if you buy it with 50% down, you're going to be cash flow positive, but with 20% down, you're bleeding money. So, you know, again, no one cared about losing money every month for a decade because prices kept going up 6-7% per year. Everyone thought, well, who cares? It just keeps going up. In an environment where prices are not going up, all of a sudden people care. They don't want to be out $800 a month anymore. So if that's the clearing price, then and the clearing price being the sort of the bottom price where people will purchase them, they'll need to come down a lot more. And I think this is why the condo market's probably, and I think why most people thought the condo market would be more sluggish right now. Because again, there's not a lot of people buying those units. I think the larger segment of the condo is going to do a little bit better, the 2+ bedrooms, 1,000 square feet, but the small ones I think are going to be pretty challenging next year.
Yep.
My Christmas wish is that real estate brokerages stop stealing consumers' effing deposits. I don't know if you guys, there's another headline. Okay, I mean, obviously, there's another one. Obviously, the big one is iPro stole millions of people. I mean, I think just today or yesterday, the Real Estate Council of Ontario posted an announcement about another brokerage, Home Life, stealing, I think 600,000 or misplacing 600,000 in deposits.
600 grand.
I mean, so basically what's happening is these companies are not making enough money. They're bleeding cash. Wow. And they're dipping into money that should be held in trust for consumer deposits, which they should not be doing. I mean, it blows my mind. I mean, it's so funny. I'm so conservative. I remember when I started our brokerage, I'm like so risk averse. I'm like, I need to have 12 months of expenses in cash. You know what I mean? Like just ready to go. Like, just in case, obviously not a good allocation of capital, but I don't know, like you want to be cautious. You want to make sure you have tons of, more than enough. But a lot of the times these brokerages, and I'm actually surprised it's taken this long. These are low margin businesses. Their fixed expenses are high. Their revenues are down. So I'm not surprised that they're going bankrupt. But the problem is if you're going broke, you should just go broke. You shouldn't be taking people's deposits, which is what they're doing. But anyways, that's my tangent. Gents, thank you so much. As always, Davin will stick around to keep an eye on the questions. So keep them coming and we'll bring on David Larock.
Thank you.
Hello, sir.
Good day, David. How are you?
I'm good. How are you?
Fantastic. David, I feel like everything has changed in the past couple of weeks. I feel like we're in this new world. As I said, I feel like last month I was talking about economic uncertainty and we're talking about interest rates eventually going down, just a matter of time. And now all of the news I feel like has shifted and the economic sentiment has shifted. Your post talking about, economic growth and good job numbers, declining unemployment, not increasing unemployment rates, and, the past decent GDP numbers. And, and of course, this flowing through to higher rates in the bond market. And now economists predicting that the next move from the Bank of Canada might be a hike rather than a cut. So what the heck is happening? What has changed so dramatically that are fueling this shift in sentiment and market pricing of interest rates?
All right. Well, first, full disclosure, John. I'm a contrarian by nature, and I think the bond market has gotten ahead of itself. I think the reaction that we're seeing today is an overreaction. We've seen the Government of Canada 5-year bond yield, which is really the benchmark rate for Canadian mortgage rates, because the other yields are tied to it, and 5-year fixed rates, which are the most popular choice for borrowers, are priced off of Government of Canada 5-year bond yields. There's other factors that go into it, like risk premiums and other cost of funds. But as the Government of Canada 5-year bond yield goes, so too goes the 5-year fixed mortgage rate, and it's up 30 basis points, 0.3%, which is a big move in the last 2 weeks. Mm-hmm. And fixed rates are headed higher. And it doesn't take long before, Scotiabank's sort of known as the bank with the most hawkish forecast. So it's not a surprise that they're talking about rate hikes or a rate hike by the end of 2026. Certainly easy enough for them to walk that back in future, and good for getting lots of debate going. I think talk of rate hikes personally is way premature. Let me go into a bit of detail. So first of all, we had the GDP data, which was stronger than expected. We had 0.6% GDP growth in Q3, which was stronger than expected. That annualizes to 2.5. So it's not, it's nothing to write home about normally, but when the Bank of Canada is expecting growth a little above 1% annualized, that's double what the bank was expecting. And we also saw revisions to the GDP forecast that StatsCan had made in 22, 23, and 24. They basically said supply chain disruptions and other challenges with data meant that their initial estimates underestimated GDP, and they made substantial revisions to our GDP growth in 22, 23, and 24. But what matters most going forward is where we are now. And the strong Q3 result we had was entirely due to a technical anomaly. We measure imports and exports, and we had flat exports in Q3, basically didn't change. We sold the same amount of exports in Q3 as we sold in Q2, but in Q2, we bought this large piece of equipment for the oil and gas sector. It was a very expensive piece of equipment that we bought in Q2, and we didn't buy it again in Q3. So our imports dropped dramatically because literally we had an anomaly in Q2. And when the gap between exports and imports widens, it looks like we have an improvement in net trade. That would be great if our imports stayed the same and we had a surge in exports. But when our export sales stay the same and the difference is we have a big drop in imports entirely attributed to one factor, then that creates what looks like a big increase in GDP that actually isn't remotely a sign of strength. So looking only at the Q3 GDP data, you would say the headline belies the underlying details. And that growth was pretty much flat. In fact, consumer spending was down in the quarter, and our economy over time is driven by consumer spending. The only kind of business investment was flat. Businesses aren't confident. That's reflected in the surveys. And the only spending that we saw was public sector spending. And again, when the government when public sector spending is basically using our tax dollars to spend. And again, if that spending is on long-term investment that's going to benefit our economy, there's really nothing wrong with it in my view. But it's not a sign of strength. The government spending our tax dollars is, we want to see private sector growth, and we want to see increases in business investment. We want to see strong consumer spending, and we're not seeing any of that. So again, I think the bond market overreacted to the GDP data. And while it's true that our economy had more momentum in the previous years, we don't have a lot of it right now, and we're pretty much trudging along at that kind of 1%, little more, 1.5% growth rate that the Bank Canada forecasts. So I don't think that's anything to write home about, but the bond market shoots first and asks questions later. And when a big GDP headline pops up, it pushes yields higher. Then the next week, we had a banner employment headline. The forecast was for minus 2,500 jobs in November. They thought the consensus forecast was that we would shed a few jobs in November. In fact, we had a banner report. We added like 60,000 jobs. And again, massive headline, huge surprise. Third month in a row where we had a much stronger employment report than we had been expecting. And the bond market, especially on the wings of the GDP headline, reacted strongly to that. And that really pushed bond yields higher still. Again, details in the data. What were those jobs? We lost full-time jobs last month. They were all part-time jobs. And most of them, the vast majority, were created in the age category from 15 years old to 24 years old. So basically what we saw is a lot of the jobs that have been going to new immigrants are now being redirected to our youth. Again, great for them. They have the highest unemployment rate of any age sector. And it's been very difficult for that category of worker to find employment. So nothing wrong with seeing them gain some jobs. But the reality is not really a sign of strength for the overall economy. The other big thing that was noted is that the unemployment rate dropped from 6.9% to 6.5%. Yahoo! Giant drop in the unemployment rate. People saying we haven't seen that big a drop in 10 plus years, and this is amazing. Our unemployment has gone way down. Okay, but half of that drop 0.2 of that 0.4% drop in the unemployment rate was because 30,000 Canadians stopped looking for work and pulled out of the labor force. Basically, when they calculate the unemployment rate, they look at people who are actively looking for work. And if you say, I'm tapping out, I'm not looking anymore, I'm out of the job market, I've given up. Now, maybe you go back to school. It's not everybody giving up, but a lot of those people would be frustrated to the point where they no longer were going to look for work. And if 30,000 people pull out of the labor force and it causes the unemployment rate to drop by 0.2%, then celebrating that it dropped by 0.4% and we haven't seen this big a drop in a long time overstates the point. It's not a sign of strength. A big chunk of that drop was because disenfranchised Canadians stopped looking for work. So again, there's nothing wrong with the employment report. It was fine. But is it, should we reprice everything and assume we're getting rate hikes now instead of rate cuts? And I mean, it's just, it has brought a lot of hyperbole into the discussion. Let's talk about the Bank of Canada. And by the way, John, I don't want to forget to add this. If you're looking at where the economy is going right now, generally the soft indicators lead. And right now, consumer and business sentiment are lousy. So generally speaking, if consumer and business sentiment are lousy, the data will follow. And if you're bullish about where our economy is headed, then you have to reconcile how the leading indicators, the sentiment surveys, you have to reconcile why they are so negative. Why aren't businesses spending? Why aren't consumers spending? Why are people borrowing more to make ends meet? I mean, to me, you have to look at overall. And by the way, even though the unemployment rate dropped last month, and dramatically so, again, in large part because people stopped looking for work, our unemployment rate is still much higher than it was a couple of years ago, and is above trend. So when Bank of Canada Governor Macklin said recently that he assessed our labor market conditions as soft, I don't think he's seen enough to change his mind. So fast forward to yesterday when the Bank of Canada met. The bank held its rate steady. That was as expected by the market. It highlighted the fact that we still have a lot of uncertainty out there because we don't know what's going to happen on the tariff file. And by the way, if we get a trade deal, if everything clears up, then all bets are off. Obviously we'll be on a different trajectory, but we are priced now as if that is already baked into the cake, and it clearly is not. I think the key thing that the Bank of Canada said yesterday that we should be paying most attention to is that uncertainty remains high and the range of possible outcomes is wider than usual. That is the bank saying, we think we're on the right path. We think our policy rate is about where it needs to be based on our projections for where we're headed, but we're prepared to be nimble and change our view if that ends up not being the case. So to me, the bank hasn't made any promises. And I think the rate hike speculation, I mean, yeah, it's boring if all of the major economists are on the same page. So there's always an outlier. It tends to be Scotiabank, and they've got an argument. I mean, yeah, tariffs could raise prices. The Bank of Canada noted yesterday, we have the lowest tariff rates with the U.S. of any country in the world, including Mexico. So there isn't evidence of that thus far. And certainly it's a view. I don't want to dismiss it out of hand. There's smart people coming up with those opinions, but for my part, I am not convinced that we won't see more rate cuts. I think my prediction, John, is that sometime in 2026 we'll get one or two more cuts. The Bank of Canada's policy rate is 2.25. It has always been lowered to 2% or lower before a rate cut cycle ends, going back over the last 5 rate cut cycles by the BOC, stretching back 25 years. By the bank's own estimate, its policy rate isn't considered stimulative until it gets to at least 2%. And based on the fact sentiment right now is lousy, both business and consumer sentiment are way down. We're not seeing businesses spend. They're voting with their dollars and they're not spending, and consumer spending is way down. And you want to talk about lowest it's been in many years. Consumer spending being dropping by minus 0.4% in Q3 didn't get enough attention as a number that should have caused concern. So I think, John, from a real estate standpoint, first of all, rates over the short term, rates are headed higher. We're not going to get more Bank of Canada rate cuts. Variable rates are going to hold steady. They're still cheaper than fixed. And I don't think they're going to go up anytime soon. That's just my view. And I should add my view, and $2 will only ever for sure get you a hot cup of coffee, but that's what I think. And fixed rates are headed higher over the short term. They're already going up. Interestingly, what will the effect be on the real estate market? I think some people have been holding out thinking that rates are going to keep falling. Those people are now no longer under that impression. So I think people who had been sitting on the sideline because they thought we were going to get down to 3.5 on fixed rates, maybe now they realize not only are rates not going to lower, but if I don't make a move and get pre-approved soon, rates could go higher, and that may spur some action in the market over the near term. Again, counterintuitively, but I think there's an argument to be made.
Yeah, that's interesting. I mean, we were talking about that with Gus and Davin. If the sentiment shifts and people see rates going up, might that push people off the market? And I do agree with you. I mean, it was counterintuitive because typically we think higher rates kind of push people to the sidelines, lower rates pull people in the market. I think in this situation, if you're right, if you think this is as good as it gets and rates might be higher, maybe we might start to see more people jump in at the start of the year. Now, what is, if we think about, what is impacting sort of the fixed rates right now? I know we mentioned a lot of stuff. I don't think the bond market really reacted to the GDP data, but it seemed there's a strong reaction to this unemployment data. And, what do you think is sort of the key drivers behind that? I mean, obviously there could be this outlook that maybe the economy's going to end up doing better than they thought, or it could be concerns that inflation is going to pick up. What do you think, if you can take off the contrarian hat and put on the bond trader's hat, what do you think they're seeing that's causing? Because of course, the bond prices take into account all the information, and obviously everyone has their biases, but what do you think they're seeing that, is causing rates to see such a sharp increase?
Probably a couple of things, John. Number one, the narrative right now is the Canadian economy is doing better than expected. And the GDP data wasn't enough on its own, but the combination of the GDP data and the employment data have fed into that narrative. So domestically, the Canadian economy being stronger than expected certainly is playing a role. Also, while our headline consumer price index is at 2%, when you add up our core inflation measures, we're closer to 3%. And there's probably concern that there's still a bit too much inflation in the Canadian economy. If you're talking about government of Canada bond yields, though, you also have to look south because we are pulled along by the gravitational pull of U.S. Treasury yields. And right now, it's very interesting in the U.S. The Fed cut rates yesterday. And the Fed, the Bank of Canada's got one mandate. They have to maintain price stability, which they define as maintaining inflation at a target rate of 2% within a range of 1% to 3%. That's the BOC's mandate. The Fed has two mandates. They have to maintain price stability, but they also need to promote maximum employment in the U.S. economy. And right now, those two forces are working against each other because the Fed is concerned about labor market weakness, but U.S. inflation is too high and higher than in Canada. So the Fed is saying we're more concerned about the weak employment in the U.S. We think we need to cut to try to help employment conditions. Interestingly, there's lots of evidence that suggests the Fed's rate cuts don't help much when it comes to the U.S. labor market, but that was the justification they used for making another cut. But when inflation is already too high, the bond market can look at that and say, okay, Fed, you're going to cut your policy rate. That's going to lower short-term rates. But if you do stimulate demand in the economy and inflation is already too high, we're concerned that inflation is going to remain too high or go higher over the medium and long term. And we're going to push up the bond yields over the longer term and demand a higher return for them because we think inflation is going to be higher and is going to erode more of the return that we get. So, in other words, the Fed lowers rates to try to stimulate growth, but the bond market responds by raising longer term rates. Longer term rates matter a lot more to the U.S. economy from a borrowing cost standpoint than the Fed's policy rates, because much more of the U.S. economy borrows at longer term rates than at shorter term rates. So, when you look at that and you say, okay, the Fed is cutting to try to stimulate growth in the economy, but if the byproduct of that is that it pushes bond yields higher, longer term bond yields higher, then it's a be careful what you wish for scenario, and it may end up doing more harm than good for the U.S. economy. But those bond yields rising in response to what the Fed is doing. And by the way, normally when you look back historically, when the Fed cuts, yields fall, because the same thing that the Fed sees as concerns feed into the views that bond market investors have. When bond yields rise when the Fed is cutting, that is an anomaly. That is unusual. And that suggests there's a disconnect between what the Fed is leaning into and what the bond market is concerned about. In this case, the Fed's leaning into weaker employment. The bond market's concerned about inflation pressure. So if U.S. Treasury yields go higher, they have a very strong gravitational pull globally. And because we have so much trade with the U.S., they have a strong impact on government of Canada bond yields. So not only do we have upward pressure domestically, but we're also our government of Canada bond yields are being pulled higher by rising U.S. Treasury yields because of this disconnect right now south of the border.
That's awesome. So to kind of unpack that, just to summarize very quickly, and I think it's super interesting because we talked about in the past how things going on south of the border impact us. So while the feds in the US are focused on unemployment, less concerned about inflation, they cut, but cutting stimulates the economy, which may put upward pressure on inflation. And the bond market,
which is already too high.
Which is already too high. And the bond market, as you said, is more concerned about inflation, which is why bond yields went up. And it's possible that part of the increase in Canada is just sort of the after effect of US bond yields going up as well. Like we get dragged along with what's going on south of the border, correct?
Yeah, there's about a 90% correlation between the direction of U.S. Treasury yields and the direction of government of Canada bond yields. So, I mean, there have been times, John, in the past where we have had a negative economic data point that should be pushing our bond yields down. The U.S. has had a strong economic data point, which pushes U.S. Treasury yields higher, and our government of Canada bond yields go up on a net basis. So in other words, the impact from the U.S. is actually stronger than the impact domestically. Now, that correlation is breaking down a little bit, but I mean, maybe it's not 90 or not, it's been as high as 95% in terms of if you plot on a graph the direction of U.S. Treasury yields with the direction of government of Canada bond yields. Our economies are on somewhat of a different trajectory now. Even with the Fed's rate cut, there's still a wide gap between our policy rates. We're about 1.25% to 1.5% different in our policy rates. That's considered quite a wide gap. That also has currency implications. But the reality is, John, you're absolutely correct. If U.S. Treasury yields head higher, they will push government of Canada bond yields higher. And it just so happens that in addition to that, we have a narrative about the domestic backdrop, which is also pushing them higher. So that's how you get 30 basis points in yield increased over 2 weeks on the government of Canada 5-year bond yield.
Yeah, that's interesting. And I think this is, when we think about how this flows through to our housing market, our economy, I mean, I tend to agree with you. I don't think the economic sentiment is going to be bullish in 2026. I still think there's a lot of weakness, and I think this is where I think it's hard for people to make sense of everything that's going on. I mean, we could see weakness, and we could see the Bank of Canada in this environment where cutting is better, while also seeing 5-year rates quite elevated because of other broader factors like inflation, like what's going on south of the border. So, and I think this kind of increase in rates can certainly shift a little bit of sentiment and might flow through to some of the things we're seeing or going to be seeing in 2026.
Yeah, and John, I think that's absolutely the likely scenario. And by the way, that would be what's called a steepening of the yield curve, and that is normal. And at this point in the cycle, basically expected. I mean, you and I have been at this a long time. Normally, if you look back over the last 20 years, if you wanted a 3-year fixed rate, you would pay less than a 5-year fixed rate. The longer you wanted to borrow the money for, the bigger the premium you had to pay for the certainty of your payment. And for a long time, after COVID and during COVID, 3-year fixed rates were higher than 5-year fixed rates. We've come through a long period where they were roughly equal. And now we're seeing 5-year fixed rates are more expensive than 3-year fixed rates as the yield curve went from being inverted to being flat to now it's steepening. So if the Bank of Canada cuts and longer term yields rise, that normalization restores the yield curve back to its normal shape. And again, that is a healthy and normal sign for the bond yield curve. But interestingly, and I've said this in my posts, the idea that you can get 5-year money for 3-year money at the same rate is people expect it now because they're used to it over the last couple of years, but that's a window that's closing and it is not normal.
That's awesome. David, before we wrap up, we got one question here about RRSP loans that are used to partly fund a purchase. Will the ultra low interest rate for the RRSP loan be lost due to the home buyers program being used? I'm not entirely sure what they mean by that, but.
Well, those are two different things. You can borrow money from your RRSP and use it towards your down payment.
Yeah.
And you don't have to pay any interest rate on that. You just have to pay it back over a 15-year period.
Yeah.
You can also lend yourself money from your RRSP as a mortgage, but you can't give yourself an awesome rate. That is a misnomer. If you want to lend yourself money from your RRSP, it's actually it's a very tightly regulated set of parameters. You have to go through a bank. You have to borrow at a prescribed rate, which is typically higher than the best rates that you can get in the market. You have to prove that you can qualify at that rate and under normal underwriting guidelines. So lending yourself the money from the RRSP doesn't increase your borrowing power. And there's some extra costs involved. So generally speaking, John, in my experience, people get all excited about the idea of lending themselves money from their RRSP for a mortgage. They do some investigating and finding out what's involved, and it dies very quickly after that. Usually once they get more, it sounds great, but once they get more information, I haven't heard of anybody or anyone who's asked me anyway, actually following through by the time they did their due diligence. So I would say, spoiler alert, it may not be quite as good as it seems on first pass.
Yeah, that's fine. I think this person was speaking with a regular RRSP loan from a bank. So not borrowing from your RRSP. I think they mean like a regular RRSP loan, but you know, basically year end, you would get a loan to basically contribute to your RRSP.
Yeah. Well, you have to that the payment on that loan is used as a liability when you qualify for a mortgage. So you're and the payment will be higher than it would be on the mortgage. So you're probably overall impacting your overall borrowing capacity. But if you're a high earner without a lot of down payment, might still make sense. I mean, there are cases where it's something worth considering, and there are actually some other things you can do as well if you have a high income and not a lot of down payment. But we get pretty technical.
Awesome. David, before we wrap up, I'm going to ask you the same question I asked the guys. If you have a real estate / mortgage Christmas wish for this year.
I wish my lender partners would staff up. It seems like every time their rates are good, I have to wait 4 days for my my answers, and I got to call longtime friends in the corner offices at these lenders to get quick responses. So let's contribute to employment growth next year, lenders, and let's hire up.
Good. That's beautiful. All righty, David. Thank you so much, and thank you all for joining. And for posting your questions. I hope everyone has a wonderful holiday season. As always, we will see you here again in early January.